Hello and welcome to Border Crossing, essential information and opportunities for international businesses with Chip Hobecker. These podcasts are designed to help you get a better understanding of some of the most important current issues and problems that affect businesses. Chip will examine the key points, help you to see the advantages and disadvantages, and provide you with any help sheets and support that you need. And just so you know, Chip heads up both the consulting division and the turnaround and restructuring practice for the firm Rehmann in the US. He has served as a court-appointed receiver, a chief restructuring officer, and as a fiduciary in international, federal and state proceedings in the US. He's also a board member for the National Association of Federal Equity Receivers, where he heads up the International Committee, and he's a fellow of Insol International. If you want to get in touch with Chip, he can be contacted via the Rehmann's website or on LinkedIn. We hope you enjoy this podcast. For every owner, shareholder or management team, building value into a business so that you can sell it for an excellent price is both a daily battle and a dream. But how do you build value? What can you do to make sure your business achieves the best price possible when you come to sell? In this podcast, John Waybright, Principal of Valuation and Transaction Advisory Services at Rehmann in the US, gives us our to-do list. John, it's great to see you again. And I am really interested in today's session because, as you know, I have my own business and we're talking about how you build value into a business. And this for me is my constant challenge to do alongside my day job as well and actually manage it all. So I'm really interested I want my to-do list, please. And also how I fit it in. That would be helpful too. So let's talk about what are the sort of the key factors that you look for that add value to a business. What are they?
Absolutely. There are several different things that drive value in a business. The number one is profitability. That's the easy one everybody thinks of.
Yeah, we know that one. Yeah.
But the others, all things being equal, or the faster your growth rate or the higher your growth rate, as long as it's expected to continue, will drive more value than a business with a similar profitability with a lower growth rate. So if you think of why do healthcare medical equipment companies have higher multiples than a plastics manufacturer, it's because their growth rates are generally higher. Turnover and utilization, how well you use your assets as far as and how efficient they are, that it drives cash flow, which ultimately adds value. And so it may not necessarily add to the bottom line, it can, but it does increase your cash flow, what we call your turnover. And that's all good because it's only good if it becomes cash. Liquidity and leverage are two other levers that we look at or drivers. The turnover and utilization will create the liquidity if you do that well, as long as you don't distribute it all out to yourself.
Yeah, it's so tempting.
We can talk more about that later. And that goes back to goals. Are you wanting to continue to grow, or are you comfortable with where you're at now and you just want to, conserve value? And the leverage is important. Having the right amount of bank debt is a cheaper cost of capital than shareholders because you expect a greater return on your money that you've put in the business and the bank is, charging you an interest. But you certainly have to be careful because you can go over that line, so to speak, where you should have optimum amounts of leverage. And the more you get past that line, the more financial risk you have. And then that devalues your business. So it's an important lever.
Yeah, I think that's the one that probably I find the most complicated actually to grasp. So perhaps we can just go through them each in turn and talk about them all in a bit more detail. So if we start with profitability, I mean, that's the one thing we all understand because that's the one and it's the one figure we probably all look at, isn't it? Yeah. So how do you go about improving it?
Yeah, part of it truly, one way to think about adding value is just for the businesses that don't have a good understanding of their information. And we certainly see some profitable businesses where the owners is just intuition is good, but they don't have the good information to really analyze everything, to get underneath some of these things so they can pull on these levers a little more. The cost structure is important. So almost all businesses have fixed cost and variable cost, especially in anything that commercial, industrial, manufacturing, but even service companies have business, a fixed and variable costs. So understand your contribution margin, and the amount of revenue it takes to just cover your fixed cost, and then the contribution margin on everything going above that. And then you can make pricing decisions more accordingly. And the more that contribution margin you add until you need to increase your fixed cost, the more profitable you will be. Now, at some point, once you grow enough, you're going to have to add another layer of fixed cost on. And we tend to see those come in stair steps. They're not on a straight vertical line on a graph. You have a level of fixed cost that stays flat, and then you've got to add another increment,
Yeah, I do know.
Yeah. And that's important to know what those are. And, that'll help in the decision-making process and lead to more profitability in the long term.
Yeah, and it's quite hard to juggle those, I think, as well, as a business owner. I found that quite a difficult sort of line almost all the time to keep it on track.
It's certainly in like a newer product line, you might not have the margin you want, but it's still adding contribution margin. So in a newer product line, until you get some more critical mass, or a new service line, in something like what we do in the service industry, getting some critical mass is important to adding value too. We didn't talk about size because the growth takes care of that, but a lot of the market perceives size as just being better, and they'll have higher multiples just because you're bigger. And the other thing is to really understand your profitability. It helps in the day-to-day decision-making process. We talked in a prior podcast about people looking to buy your company. If you really can talk to them about what your profitability looks like by your customer or your product mix, and what that does in your mix. Even in our business, we have different margins. All of our business lines are profitable. We have different margins on our audit group versus our tax group versus our consulting group. If you are a manufacturer, if you have 7 or 8 different product lines, some of them are more profitable than others, and customers are more profitable than others. So understand how that mix affects your profitability is important in the decision-making process, and where to invest your dollars. Where do you want to, part of it is where do I want to spend my time focusing? Because in reality, we all think we want to just grow everything evenly. But if I'm going to get 80% of my profitability from a couple of product lines, where do I really want to invest my time? We can still play around with the other 20%, hope they grow. But we really want to focus on the ones that are making us, continuing to add cash flow to the bottom line and are probably growing faster than the other ones that we hope are going to grow.
Yeah. Sorry, it's quite a difficult thing, I think, in professional services as well, because as opposed to, say, a product line, though I'm sure it happens there as well, in that you sometimes attract customers in on one of the things that isn't particularly profitable, and then you sell on the stuff that you actually make more money on. So, or you have to provide that because it actually keeps that's 80% happy if you're also doing that little service over there. So it's quite a difficult juggling act, isn't it?
And that is, and we make those decisions in our business all the time on, you may start with a client that's a very small doing something, and, you hope to expand on your services. You hear people talk about loss leaders and selling products, so they can get more work later. And all of these are decisions. The more information you've got, the better you can make them. But it is really important to know, more than just intuitively, but through analysis, what customers and what products am I really making most of my money on? And I want to make sure I take care of those first and not just assume they're taking care of themselves. So part of that might be, we'll call it conservation of value. We're all thinking about building value, but you can also do some things that will actually not preserve value, but actually detract from value. So
you mentioned the growth before. So where exactly does the growth fit in? You said briefly that people want to see it growing, but I've known a business that wasn't really growing, wasn't making a profit, but they sold for a lot. So, where does it fit in?
And that goes back, again, in growth, first of all, there's top line revenue growth, is what we all think of, but in most industries, it needs to translate into bottom line growth too. Otherwise, you're just making yourself busier to have more revenue, and the bottom line's still the same. Certainly in some businesses and some industries, they're only worried about top line growth. And that would be, a lot of the technology, if they've got the right product and they're spending a lot of money on R&D, so the bottom line is not good, but they're growing the top line, that growth turns into more value because those businesses are typically selling on a multiple of revenue. There are businesses that don't sell or that do sell for good multiples that have become very mature and are not growing. But, they should, I would think in that case, they would be profitable if they're going to get a healthy multiple. Someone might want their customer base, though, and still pay a lot for it, even if the business itself is not profitable. And so they look at it that way. There's a lot of different things that go on. But all things being equal, if you've got two businesses, pick a size, 100 employees, 15 million in revenue, if profitability is better and growth is stronger, they're going to sell for a higher multiple than a business.
Yeah, no, I can see that. So, you talked about turnover before, and I know that with turnover, it's very easy to get very hung up on that as a business owner. You're constantly, you said this yourself, that you're constantly looking to increase that turnover, but not necessarily looking at whether you're actually utilising what you have to its full capacity. You just keep chasing new work and you're chasing the new client, but you're not actually being that efficient in the way that you're approaching things. And I know that I'm guilty of that. So what is that common, or am I just a freak? You into being like that? Please tell me there's other people out there that have this issue.
Well, there are a lot of people doing that, especially when you have some free capacity. Idle capacity doesn't, whether it's in people, whether it's in your production lines in the plant, or excess capacity in your warehouse, you're just paying for space you're not using. None of that doesn't ultimately add value. It's actually decreasing value because you got a cost that's not really, that you don't need. The question becomes, can you grow into it? So I think what you're thinking, and we do the same, is if I have some excess or idle capacity, I will go out and look for business and maybe take a little bit lower margin to fill up that capacity because that cost is already fixed. And that goes back to understanding your fixed and your variable cost and, what your incremental costs will be. A lot of times we like to have real life case studies, and I'll give you one. Worked with a manufacturer once that, they had a lot of excess inventory, not obsolete. They didn't really look at their production levels, and they felt like they could lower them. So we went through an analysis and a project, and we were able to reduce inventory levels by about a third. So they were only carrying about 67%, and still took into account all their lead times and customer service metrics. So they didn't miss shipping, didn't have missed deadlines with key customers, and didn't have, we called it case fill in this example, where, they were supposed to ship 100 cases and we're only shipping 80 because they didn't have the right inventory quantities. And so ultimately we freed up 33% of what was in inventory into cash flow to be invested into other things. So that's a real life case example of value that was added. And this company typically had, 20 million in inventory. It was decent size. It was bigger than some of the dollars we were talking about earlier. So if you can get down to where you're only carrying 13, 14 million of inventory regularly and not 20, that's freed up $6 million in cash.
Yeah, that's a big impact, isn't it? So, also there's the whole issue of payments, isn't there? And the sort of processes around the money that you're getting in. And I know that's something we've really tightened up on recently. Does that contribute to building value, sort of getting that kind of thing right?
It does. It's a similar example to the inventory where it's freeing up cash flow. So if my collection period is 35, 38 days and my company is running at 50 to 60 days, I'm losing, 25 days of cash generation. And the old saying, I can't pay my employees with receivables. I have to actually have the cash. That's important. And that's similar to inventory. If I can get my collection period down from 60 days to 40 days, whatever my receivables are, I've now freed up 33% of them and it's sitting in cash that can be invested in other areas. Part of that is, everything kind of is interwoven. We want new customers and we want good customers. And so sometimes in the thirst to get revenue, we take on someone without doing the credit background checks and some other things that we need to do. And the lesson there is to stay on top of your customers and your collection periods, and to be willing to put them on cash on delivery if you're shipping them product, or a retainer for services if you do what we do. So you make sure that you have the cash, because at the end of the day, receivables that you don't collect, they're going to get written off. That's a hit to your net income. It's an issue, and
huge issue.
We need to look at take all those into account.
Yeah, I know. I always jest with my other colleagues about how human resources and cash and finance are like the most difficult things that we have to do with. It is really tough. And I think getting money out of clients can prove so difficult sometimes and really disrupt you.
Those are tough conversations. And I think collaborative communication is key. I mean, some people really have a good history of payment. They really want to pay you. There's that bucket of customers that will slow pay you just because they can.
Yeah.
But there's others that will pay, but they've run into some tough times, and maybe you've worked with them for years. So, collaborate with them and come up with a payment plan. And those type of customers, they will pay you when they get the chance, and turn maybe back into a not a slow pay customer. They just need to get over that hurdle of whatever's happened to their business. So, in kind of grading your customers, a lot of places do kind of an ABC, and, where do you really want to spend your time? You want to spend it with your A customers. So, and sometimes we keep C customers, whether it's service or, retail, manufacturing, whatever, because we don't want to lose the revenue, but you can free up time and go find more A and B customers.
Yeah.
And it's hard to do because you say, oh, if I let them go, I've just lost that revenue. And what if I don't get it back? But I think we need to take a hard look at, who we deal with, and, are they really a profitable relationship? And if they're not, can we make them into a profitable relationship or not? So, and if we can, great. But if we can't, you may be better off spending your time elsewhere.
I think we're quite good at that, actually. We've had a couple of clients that you end up spending all the time and all the stress, and you're getting a minor amount of the money from them. Right. And I can always tell from the team, who is it that's stressing us? And then, right, we need to lose this one. So,
and it's important in whatever your business is, because you're taking up time for minor profitability, and you're creating stress.
Yeah, it's the stress as much as the money. It's time consuming, and they wish out the loudest as well.
And they can. That's true, and that leads to things that aren't as easily measurable. But dissatisfied employees, we've all seen studies, and because they're not happy because they're spending half their time instead of 5 or 10% of their time dealing with those customers. So, we're going to have them. But you certainly don't want them to be a significant block of your time.
No, absolutely. And that brings me on to something else, because one of the other issues that I find that I'm always juggling is capacity, and sort of how to have capacity in case the work comes in and how to utilize it best. It's another really hard sort of juggling act.
It is. And in the service industry, there's the old saying, I want to be a half person overstaffed. And that's kind of, how can you have a half a person sitting around?
Oh, I have no qualms about cutting them up. I'm joking. That's a gag.
But, I do believe you can't run at 100% capacity. So you want to always have a little bit of excess or idle to be efficient, to take on a new customer, a new project. Some manufacturing concerns where we've worked with analyzing things. For example, every manufacturing plant typically has a bottleneck. And so you have to analyze the throughput through that bottleneck, and which means other areas that are not the bottleneck, you can't run at 100% capacity, because all you're going to do is get product faster to the bottleneck and jam it up even more. So you have to look at that. So having that little bit of excess capacity, whether it's in human capital or production line, one, it allows for you to take on the new customers or And two, it keeps from jamming up wherever the bottleneck is. And there's office bottlenecks just like there's plant bottlenecks too, where some things just by nature can't move through what we do as quickly as some of the other things. So you have to kind of understand what process takes the longest and make sure you don't just create a bigger bottleneck.
Yeah, I think bottlenecks are something else that so therapeutic to solve.
Yes.
We've had a few, and when you suddenly see it start to work better because you've put a system in there that's just changed it, it's a great feeling. It really is.
That's the thing about the first thing in understanding your bottleneck is the process already as efficient as it can be?
Yeah.
And sometimes the answer is no, obviously, and then you could fix it and free that up. But there are certain areas where the throughput has to be slower no matter how efficient you are in that area than some of the other areas of your office or your plant or whatever it might be. And certainly I use a plant as an example. Let's say you've got a finishing department that has to do a more detailed work on some type of a gray iron casting. And you can't just run the production lines full out to get it to the finishing if they can't keep up. And there's other ways around it. I've seen places that run certain parts of the plant 3 shifts and the other parts 2 shifts. So that third shift is used for, catch up. But if you ran the other parts of the plant 3 shifts, all you would do is just create more work than the bottleneck can do. And you have to schedule around that. And that creates profitability because it helps you in your planning, helps you keep your customers happy, helps you keep your quality up. That's one thing we didn't even talk about, but it's an intangible, but pure quality or poor quality will hurt value in whatever you do, whether it's the service or a product. So.
Yeah, no, that's really interesting. Leveraging that we talked about before, that's an area that I find quite difficult to get my head around and altogether. So, would you mind just explaining it in a bit more detail and how you can create value through it?
Yeah, you can actually, we call it in the valuation world, lowering your cost of capital or your discount rate for your cash flows. And if you think about it, most people, if they put equity in the company, they want, depending on the stage the company's in, but let's just say they want a 20% return on their money, or even only a 15%. You can go to the bank as long as you're creditworthy as the company, and you can borrow money at maybe 5 or 6%. And in the U.S., tax deductible, so the after-tax cost might only be 4%. So what mix of capital do I want at 15 or 20% rate with the people with equity versus the bank debt would just cost me 4% after tax? So bank debt can be used to fund growth because that capital raises are expensive. They're time consuming to get new capital in unless you're just going to put it in yourself. You can use bank debt to help fuel your growth, but you have to be very careful about how much debt is too much debt. Different industries have different benchmarks that we can look at to determine where we think somebody is getting a little bit too leveraged. Because once you take on too much leverage, now your debt service becomes harder. You can get yourself over levered, and then you're going to stunt your growth. Then you're going to become, the bank will look at you as having potential maybe default risk. They'll up your interest rate, so that'll even become more expensive. So there's all those different levers we look at. That's probably the one that I would look at last, unless somebody's already over levered completely, is how do we get that down? Or somebody who's using no debt at all, and just talk to them about, have you ever thought about maybe using some debt in your operation? Because
it can be positive, can't it, sometimes?
Yeah. And back when I first started my career, we saw a lot of the businesses that were owned by World War II and Depression era vet people. They were more debt averse. So you saw them not want to use debt because they remember all the bad things that can go along with it. But it can be used to help fuel your growth as long as it's used in the right manner.
Yeah. And I think the interesting bit is about not overextending. How do you, as a business owner, spot when you've overextended?
One of the easiest ways or quickest ways, if you would talk to your bank and they want a higher return on the next tranche of debt. Yeah, that's a very obvious one. But, I would say you can look at initially don't get more than maybe 20-25% debt to equity ratio. Some industries are certainly more manufacturing, and you've got a lot of plant and equipment. Then you're getting a lot of term debt that's tied to the property. So service businesses are different. So it's really by industry, but I would be conservative on how much debt you take on. Make sure you've got plenty of cash flow. Make sure you're not going to have any trouble meeting all the bank's loan covenants, that you're staying in compliance. And the other thing is also, certainly you want to take a reasonable compensation and you want to get a good return on your capital. But if you do want to grow, and again, it goes back to objectives. Some business owners are like, hey, I've got to this point. I'm not looking to grow anymore because I'm tired. I'm going to sell it in a few years. And if I try and grow, it's just going to create more stress. But if you are looking to grow, just be careful how much you distribute, that retains some of that cash flow in the business. So yes, you want to cover your tax liabilities. Yes, you want to get a good return on your capital, but you don't have to distribute every dollar, because if you do, when it comes time to grow, you've either got to put it back into the business yourself after you took it out, or, the bank's going to be, because you got less liquidity, they're going to be a little less likely to maybe, or at least restrict how much they're going to give you on the borrowing side, or going to restrict your future distributions. Things, we see that happen too, where the loan covenants say you can't distribute more than X% of your profit.
So it's really doing that future financial planning piece, isn't it? It's getting your cash flow right and looking at what's coming over the next year and what you want to do.
Exactly. And we haven't talked about that, but I'm a believer, do projections for at least the next year, if not even try and do a high level year 2 and year 3, maybe more detailed in year 1. First thing we know, a projection is not going to turn out, exactly right. But I think it makes you think about your business. And I also think it helps us to be more nimble, to react to things, what I planned on. And maybe, you think, because as you're putting your plan together, you might think you're thinking of the different levers and maybe different customers. And if this happens, great. But if not, I'm going to do this. And so just thinking about the business when you put the plan together, I think has value. It's not as readily measurable, but it reaps benefits in the long run.
But one of the things that everybody always said is work on the business, not in the business. Now, I think probably most entrepreneurs like me, and I do know this because I've talked to at least 3 today, they all work in the business and try very hard to work on the business at the same time. So knowing that they shouldn't be doing it, how do you go about doing all this and building this value? Because it's a big job looking at all these things, and you need to take a step back and look from a distance, but that takes time and they're not small jobs to do. So what ways have you seen people manage to do this? Do they bring someone in? Do they actually extract themselves? What are the different options open to people to actually get on top of this?
That's a great question. And you're exactly right. You need to have time to step away to think about, working on the business instead of in it, but you get tied up in the day to day. I mean, certainly some of these projects, we can help you with at Rehmann. We've done some of the analysis, and we've already talked about an example of somebody who knew they had too much inventory, didn't know how to approach it in my past. And we worked and got inventory down by 33% without having any customer fulfillment issues. So we're glad to help on many of the levers. But as far as your own time, I'm a believer, if you don't delegate and bring good people in, the smart, people that are smart, the old saying, hire smart people, let them do their jobs. You're going to hit a ceiling based on your own capacity.
That's why I have a flat head, John.
Yeah, that's right. So, delegating, bring those people in, that can handle operations or sales or marketing or, whatever, depending on your business and what your strengths are. Spend time on your strengths and let somebody else handle your weaknesses, number one. And number two, don't spend so much time on your strengths that you forget to do the quiet thinking, so to speak. I can't remember if it was Steve Jobs or Bill Gates. Somebody said, I need to be thinking about thinking, not doing so many hours a day. They were spending a couple of hours a day just thinking about the business, not specifically doing anything, not reading emails, not, but actually, what do we need to do next? Where are we going to grow? What issues are there? How do we get it fixed? So they weren't in the business during those hours. They were working on the business. So
I think that's dog walking, isn't it?
yeah.
That's what I use it for.
Exactly. And maybe you need to get away. Some people, even, I know it sounds funny because it's an activity, but, you and I were talking about you went to the driving range the other day. Some people might be able to think well on the driving range, even though they're mindlessly hitting balls. So they're not really thinking about the golf. They're thinking about their business, but it gets them out of the office or wherever you need to be, where all the interruptions take place. And that keeps you in the business, not on the business. Yeah. Otherwise, you got to do it late at night, early in the morning. And, and there's only so many hours in the day. So how do you want to spend them? So.
Yeah, no, absolutely. So can you give us an example of a business where they've built real value in and then got a better sale price as a result?
The business on the inventory, they did sell later and for a very high multiple. Now, this was also a profitable business, so that just added some incremental value to the sale.
Yeah.
They would have sold for a nice multiple anyway. When I think about a business kind of we analyze customers on, and they let from a revenue standpoint, a fairly good size customer go that, but the margins weren't great and they were constantly putting price pressure on and, wanting more and more for the same level, if not a price decrease. Ultimately, they told this customer after we did some analysis, we do everything you ask. We're going to reserve the right though to price our product and services appropriately, and this is our price. And the customer didn't like it, so they left. So they didn't officially fire the customer. They just said, this is it, and take it or leave it. They were able to replace that customer with not one, but a handful of other customers that were more profitable, got them into a growing business segment. It took 2 to 3 years, but the bottom line, growth was significant after they got into the other.
And they spread their risk because there was more customers rather than just the one.
Yeah, and we've all heard, like here in the U.S., I mean, they're all good companies to work with, but, you start working with, some of the big three in automotive or the big box retailers, they will put price pressure on people, especially the smaller suppliers. So you have to be ready to deal with it and think about, what's the cost of all that.
Yeah, I'm actually still owed some money from an extremely big, well-known international company. And they've owed me it for 11 years now and still haven't paid. And it's exactly that. They're massive. And, we're an SME. And you just think, really? And yet other SMEs are always so nice and, tend to pay quite quickly because they get it. They understand.
Yeah, and in this case, the customer paid regularly, but the pricing pressure and the more they asked to do between wanting more for the same price or certain things wanting a lower price, it's not, like I said, they didn't officially fire the customer. They just said, hey, we're doing all these other things and we reserve the right to price what we do. This is the price on these things, and take it or leave it.
Yeah, I always jack the price up really high.
So, and that's determination. They didn't necessarily want them to go, but they were not going to do it for what was being asked.
The problem I've had is they've usually then paid it. We want them to go away.
If they want cheap pricing and still want to pay slow, that's a big red flag. Those are a few examples. And again, I think ultimately the better understanding and the deeper you can get under your data, the better decisions you just make every day lead to overall more profitability. And sometimes it's not this big home run where, you did something and you can just measure that project alone and it brought up, another $1 million of profit, but it's just doing the incremental steps and understanding your business better. And not just having it in your head, but on being able to show your metrics, being able to really track what you're doing.
Yeah, no, that's brilliant. Honestly, John, that's given me a really helpful to-do list.
Number one point is go to the driving range and do your thinking.
Yeah, I will, I promise. And then I'll come and play you at golf and you can laugh.
But there's so much going on. And I guess the only other thing is, once you've analyzed these things, then spend your time where the big benefit is. Go after the low-hanging fruit.
Good tip.
Yeah, because otherwise, yes, some things might add some incremental profit, but they're going to be time consuming and not have the impact. So if you think there's a couple of areas to work on that are a big priority, don't even worry about the other ones. Just do the big ones. So.
That is a good tip, because I would have systematically worked through it otherwise.
Yeah, one initiative is a lot. Sometimes we think about, I want to do 10 things, but in reality, if it's one big initiative, that's a lot of time. So
yeah, no, absolutely. Thank you, John. That's been great. Really helpful. So if somebody wants to get hold of you, where's the best place to find you to talk about doing this for themselves?
Certainly message me on LinkedIn. You can find me, John Waybright, and my email is john.waybright or John.Waybright at Rehmann.com. That's REHMANN. And then certainly you can also just call my direct dial, which is 407-270-3953. So.
That's brilliant. Well, thank you so much. And I expect I will see you again very soon.
That sounds great, Becca. Thank you.
Thank you for joining Chip for this podcast. If you want to get in touch with Chip or any of his guests, please contact him through the Rehmann website, www.rehmann.com, or on LinkedIn. All views expressed in this podcast are individual opinions and do not constitute professional advice. Thank you.